So here's something people ask me all the time. Should I be in mutual funds or ETFs? Honestly, both are great, but there are some factors that should go into your choice. Let's break down the key differences and the pros and cons of each, and why your 401k probably still uses mutual funds. Now, both ETFs and mutual funds are baskets of investments. They can track an index like the S&P 500 or be actively managed by a professional. You don't have to pick individual stocks. The fund does that for you. Now, let's be a little silly with this. Think about a fruit ETF. Instead of buying shares in every fruit company, you can buy one ETF or a mutual fund, either one, that includes the top 1,000 fruit companies. You'd get Adam's Apples, Limes Unlimited, and the banana stand. And remember, there's always money in the banana stand. So you get the idea. One trade gives you exposure to the whole group of stocks, or in this case, fruits. You own them all. You can make a nice fruit salad. A mutual fund or ETF holds all of these in one container, like a fruit salad bowl, so you don't have to worry about picking them individually. ETFs are bought and sold throughout the day, just like stocks, so that means you can trade them anytime the market is open. Most ETFs, at least historically, are passively managed. It means they track an index automatically instead of relying on a fund manager. Although there are more active ETFs coming to market all the time now. They're becoming increasingly popular. But the index ETFs are cheaper and usually more tax efficient. Mutual funds, on the other hand, are often actively managed. A portfolio manager is picking the investments. You can't trade them throughout the day. They're priced just once daily at the end of the day at net asset value. Now, mutual funds may have higher fees, and that's partly because you're paying for management, at least in the active funds, okay, where you've got somebody picking those stocks for you. And there's often some additional charges called 12B1 fees, and these are often bundled into the overall fee for the fund that you own in your 401k, but they can add up and make the price higher than you might have paid for a simple index fund. And again, that's where the manager just buys all the pieces of fruit rather than picking out the ones that she thinks are best. Now, just apply that image to stocks and you get the idea. Let's walk through the key differences between ETFs and mutual funds. ETFs trade all day. Mutual funds trade once a day. ETFs are generally cheaper and more tax efficient. And mutual funds, though, remain the most common investment in retirement plans. Now, I'll talk a little bit about the taxes. I've kind of mentioned that in passing so far. ETFs are built to be more tax efficient. An ETF manager accommodates investment inflows and outflows using what are called creation units. And that's, in basic terms, that's just a big bundle of the ETF's underlying stocks, gets traded between the ETF provider and large institutions, not individual investors. But what that does is it helps ETFs avoid triggering capital gains taxes when people buy or sell their shares, because the investor, as you, is not exposed to the capital gains on the sale of any individual security in the underlying structure. Mutual funds, though, well, when the manager sells something at a profit, you may owe taxes even if you did not sell anything. And these capital gains are then distributed to you, the investor, even if you haven't sold your shares in the fund and the overall value of your fund has decreased. Now, outside of 401ks or tax-advantaged accounts, this is what goes on. These are called phantom gains or phantom income because you're taxed on income you have not technically received in cash. So it depends on the fund's trading activity, not your own. And once again, this is what happens if you're holding these in a taxable account, not something like a 401k. One more word about fees. As of 2025, the average expense ratio for an index ETF is about 0.14%. For equity mutual funds, it's closer to 0.40%. Now, that may not sound like a lot, but over time, those extra costs can cut into your returns. So, if ETFs are cheaper and more tax efficient, why aren't they more common in your 401k? Here's why. Historically, mutual funds shared part of their fee with plan providers, and that covered administrative and record-keeping costs, very important stuff there. But ETFs usually don't share that revenue, so providers have had less incentive to include them. Now, that is starting to change. Newer 401k platforms are adding ETFs. Zero revenue share models are gaining traction, and that means that more ETF options are increasingly becoming available in 401k plans. Now, don't get me wrong, mutual funds still make sense in many cases, especially inside retirement accounts. Think about the tax treatment that I talked about a minute ago. In a traditional 401k or an IRA, you're already getting tax deferral. So the tax advantages of ETFs don't matter as much in that case. And if you're investing for the long term, intraday trading shouldn't be so important to you either, since you should not be in there actively shuffling around the holdings in your 401k. Just don't do it. And some index mutual funds, like Schwab's S&P 500 fund, the fees are as low as ETFs, so you don't have to choose one over the other. Now, if you're ready to start investing with ETFs outside your 401k, it may be easier. You don't need minimum investments as you do with some mutual funds. And even with some mutual funds, the minimum investment is pretty small or non-existent to accommodate more investors. So you can invest a lump sum or set up an automatic savings plan for as little as about $25 a month in some cases. Mutual funds are actually a little better suited for automatic investing because you can just assign your fixed dollar amount and invest the whole thing in a fund, whereas ETFs are bought in shares. So you may have some cash left over in your account when the deposit has been invested in the set amount of full shares. But you know what? I don't want to get into the weeds with stuff like that. Just invest. This is a place where analysis paralysis or trying to choose the right thing, the exact right thing without making a mistake, that's worse than just starting to save for retirement in either a mutual fund or an ETF. But remember, like any investment, they both carry risk. Make sure you understand what's in the fund, what you own, and how it fits in to your overall strategy. So, which is better, ETFs or mutual funds? You know, it really depends on the account type, your goals, and how hands-on you want to be. And remember, I don't like the trading in a 401k or even an IRA. Don't be shuffling everything around. Defeats the purpose. Now, in a brokerage account, ETFs offer flexibility and tax advantages, but in a retirement plan, like a 401k, mutual funds may still be your best choice. They may be your only choice, actually, and that's okay. You want to build your own ETF portfolio? Check the link in the description for my free guide and let me know in the comments. Do you invest in ETFs, mutual funds, or both?